Hello everyone. In this video, we will be talking about corporate debt. When companies borrow money, they promise to make regular interest payments and to repay the principal to the lender. However, this liability is limited. Stockholders have the right to default on the debt if they are willing to hand over the company's assets to the lenders. Clearly, they will choose to do this only if the value of assets is less than the amount of the debt. Because lenders are not considered to be owners of the firm, they do not normally have any voting power. The company's payments of interest are regarded as cost and are deducted from taxable income. Thus, interest is paid from before tax income, whereas dividends on common and preferred stock are paid from after tax income. Therefore, the government provides a tax subsidy for debt that it does not provide for equity. Although, in the case of issuance of corporate debt, the company promises to pay interest and principal on time, but there is always a chance this company may fail to fulfill this promise. That means the borrower will fail to pay the interest and principal on time. That's why the corporate debt is associated with a default risk. The default risk means the probability or the likelihood that the borrowing company will fail to pay interest and principal on time. And there are credit rating agencies that usually rates the bonds or the corporate debt based on this default risk. Typically, a bond or a corporate debt with low default risk is rated high, for example, AAA, whereas a corporate debt with high default risk is rated low, for example, BB, which indicates high default risk. And also, the high default risk debt or bonds typically offer a higher return or higher yield to maturity to investor compared to the debt that has low default risk. Now, when a company wants to borrow, the financial manager needs to answer these questions. First of all, should the company borrow short term or long term? So you understand that if a company simply needs to finance a temporary increase in inventories ahead of, say, a holiday season, then it may make sense to take out a short-term bank loan. But suppose the cash need is to pay for expansion of an oil refinery. The refinery facilities can operate more or less continuously for 15 years or 20 years. In that case, it would be more appropriate to issue a long-term debt. The next question can be, should the debt be fixed or floating? The interest payment or coupon on long-term bond is commonly fixed. For example, if a $1,000 bond is issued with a long-term interest rate of 10%, the firm continue to pay $1,000 as interest per year, regardless of how interest fluctuates in the market. Most bank loans and some bond offers a variable or a floating rate. So in that case, the interest rate will vary with the market interest rate. For example, the interest rate in each period may be set 1% above the LIBOR. LIBOR is the London Interbank Offer Rate, which is the interest rate at which major international banks lend dollars to each other. So when LIBOR changes, the interest rate will change. If LIBOR goes up, your interest rate will go up. And if LIBOR goes down, your interest rate will also decline. The third question is, should you borrow dollars or some other currencies? Many firms in the United States borrow abroad. Often they may borrow dollars abroad, but firms with overseas operations may decide to issue debt in a foreign currency as well. And after all, if you need to spend foreign currency, it probably makes more sense to borrow foreign currency. Because these international bonds have usually been marketed by the London branches of international banks, they have traditionally been known as Eurobonds, and debt is known as Euro currency debt. A Eurobond may be denominated in dollars, yen, or any other currency. The next one is, what promises should you make to lender? Lender wants to make sure that their debt is as safe as possible. Therefore, they may demand that their debt is senior to other debt. If default occurs, senior debt is first in line to be repaid. The junior or subordinated debt holders are paid only after all senior debts are satisfied. The firm may also set aside some of its assets specifically for the protection of particular creditors. Such debt is known as secured, and the asset that is set aside is known as collateral. And last question to be answered by a finance manager in the case of issuing debt is, should you issue a straight or a convertible bonds? Companies often issue securities that give the owner an option to convert them into other securities. The option may have a substantial effect on value. For example, a convertible bond. A convertible bond gives its owners the option to exchange the bond for a predetermined number of shares. The convertible bondholder hopes that the issuing company's share price will jump up so that the bond can be converted at a big profit. But if the shares jump down, there is no obligation for the bondholders to convert. The bondholders remain bondholders. The word debt sounds straightforward, but companies make a number of promises that look suspiciously like debt but are treated differently in the accounts. Some of these disguised debts are easily spotted. For example, accounts payable are simply obligations to pay for goods that have already been delivered and are therefore like short-term debt. Other arrangements are less obvious. For example, instead of borrowing to buy new equipment, the company may rent or lease it on a long-term basis. In this case, the firm promises to make a series of lease payments to the owner of the equipment. This is just like the obligation to make payments on an outstanding loan. Here is another example of a disguised debt. At the end of 2008, Honeywell had promised its employees post-retirement healthcare and life insurance benefit valued at $17 billion. However, Honeywell had set aside only $8.5 billion to help meet this obligation. So this unfunded obligation amounted to 8.5 billion. So you understand that's an example of a disguised debt. Now, there is nothing underhand about any of these obligations. They are all clearly shown on the balance sheet or explains in the notes of accounts. However, sometimes some companies go to considerable lengths to ensure that investors do not know how much the companies have borrowed. For example, Enron was able to borrow 658 million by setting up a special purpose entities which raised cash by a mixture of equity and debt and then used this debt to help fund the parent company. None of this debt showed up on Enron's balance sheet. So this is the end of our discussion on corporate debt. Thank you very much.